Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissonou with my co-host Kevin Casey, and today we are joined by Logan Mohtashami. How are you today, Logan?
I'm doing wonderful. How are you doing?
We are very, very good. Thank you. So, has there been anything happening this week? Let me think. All right, forget about this week. Let's just start with what's about to happen. So, tomorrow it is retail sales, industrial production, and a 20-year bond auction, which it will be interesting to see who buys our bonds. Hopefully somebody buys the bonds, but will it be foreign entities? Will it not? Who knows? And then we have Jerome Powell speaking at 1:30 Eastern tomorrow. Now, I would imagine that could potentially move a market, so, stay posted. Then on Thursday, we have initial jobs claims, housing starts and permits, and then the market closes for the holiday and is closed all day Friday. Now, that to me feels like a holiday when I don't have the ups and downs and ups and downs in the market. But,
Well, that also means don't lock on Thursday because never lock on the day before a 3-day weekend.
well, I typically would agree with you, but considering the situation currently, I managed to not call it a show. Anyway, I don't know. You got to like take it when you can get it, right? So,
Yeah.
look, Kevin and I have a little thing on here. If you see a rate you like, lock it in. Yeah. Meanwhile, back at the 10-year treasury, this morning when I first looked, it was 4.32, which seemed amazing because last week we were at 4.5. And if you think
Well,
about
no,
it,
we weren't
today,
just at 4.5. We were at 4.2 and 4.3 and 4.25, all within an hour
It
period of
it
time.
it was a pretty it was a pretty wild scenario actually from Jobs Friday when I looked at all the labor data that week. The 10-year yield should have been trading at 435, but because of all the market stress and stocks selling off and money gone to bonds, it drove the yields below 4%. And I remember that Sunday night talking to everyone on Instagram that said one little thing, and this is going to be a face ripping reversal in yields. And I think we got an intraday trading high of like 458. You get wild trading overnight. That's when you know things are pretty chaotic. But where we are right now, currently, where you look at where Fed policy is, like for like 65 to 75% of where the 10-year yield can really go within economic cycles, it's really Fed policy. So the 10-year yield looks correct to me. Of course, if economic data starts to get weaker and weaker and weaker, it becomes a challenge for the markets trying to think, is the Fed going to get more aggressive on rate cuts? If that's the case, I know Fed Chairman or Fed President Waller yesterday made the case that he would rather cut rates more aggressively if you're going into a recession. So there are key economic data lines to track for every economic cycle, and we're a little bit more mindful of them now than we were last year.
huh. Well, just a reminder, we were at 4.8 in January. So in contrast to that, the today, well, and it was interesting. Today I saw 4.32. And then I looked again and we were at 4.31. And then I looked again and we're at 4.3. So we are headed to, this sweet spot per Logan. He was explaining this to me earlier. And I think it's really interesting, especially in light of the idea that Treasury Secretary Scott Bessent has indicated that he thinks that 3.9 is where they'd like to be. And I was asking Logan to explain how much they can influence that. So why don't you talk about that a little bit, Logan?
Well, there are ways that the Treasury Secretary has discussed. Obviously, when they issue a lot of debt, they're going to try to get it to the shorter end duration to make the supply on the long end less. I mean, we've really never had a bad bond auction, like, a failed bond auction here in America in decades. So I think they just want to keep that supply on the shorter duration side. But there's also regulations that I assumed that they would do this already before going into the kind of the trade war, so the markets would be less volatile. But you can allow banks and to hold more treasuries to make the market a little bit more fluid. There are levers that we can pull, the Fed and everything, to calm things down. But what we saw is that all the crazy hype about 10-year yield maybe getting to 6, 7, 8%, nobody wants our debt, all the Mickey Mouse doomer boomer stuff that we hear for one group of people for decades. The market kind of calmed itself down. It was a very, very vicious stock sell-off because no one was prepared for Godzilla tariffs. And you could see how wild things could get in a very short term. But for now, without any crazy headlines, we're in a much better place, a calmer place. The bad part about everything is that the mortgage spreads have gotten worse. They were always improving this year, and the spreads always acted better when bond yields went up, so it kind of limited the damage. An event like this, like the Silicon Valley banking crisis, can make mortgage spreads worse. And if you look at the history of the mortgage spreads going back to early 1970s, market stress is a variable that can create the spreads to act more erratic than normal.
I think erratic, volatile. There are some little words that seem to summarize where we are currently. It is okay, so just let me back up just for a second because I just wanted to briefly mention that there is a Greater Ventura Camp Lender Fair on May 15th. Please join us. It'll be fun. It always is fun. And also make sure that you're watching or reading or listening to or whatever the Crispin commentary, because there is a lot of interesting information in there, including they were talking about the Fannie fraud that was discovered that I thought was very interesting.
That was really crazy.
Isn't that crazy? Okay, so I don't know much. All I know is it was 100 people who were fired. They were out
I
of
thought it was 700.
Well, no, this was just the fraud part was the 100. And then there was, maybe Logan knows about the other 600. So the 100 out of India, and they were running a scam that was similar to the scam that was run involving charities and Apple a few months ago. So anyway, it's complicated. Crispin explained it well, which is why I just thought of it just now. And I'm like, I mean, who gets a job like that and then blows it by running a scam? I don't get it. I do not understand it at all. And also it makes me a little cranky because we are held to such a high standard as far as fraud goes on the lending side of it. So to think that Fannie is having that going on within its own organization is a little frustrating. Let's go with frustrating, shall we? All right, back to Logan. So Logan, very interesting. If I looked on, say, Instagram, and I saw that you are known as the chart daddy. Chart daddy. That is quite a, and also action figures. Now, can we buy these at Target? Now, where do you get a Logan action?
My fans actually create merch for me, like shirts and hats and mugs and everything. And there's an app out there where you can make yourself into an action figure, and someone created that action figure for me. And then of course I have haters as well, and they created their own version of an action figure. So the chart daddy thing, it actually Sarah and I were doing our podcast, and she was saying that, you always got all these charts, and then I just haphazardly say, yeah, I'm the chart daddy. You come to me to get the charts. And it took off. And everywhere we went, everywhere we went, people were they were just calling me chart daddy, chart daddy. They're giving me t-shirts, chart daddy, mugs, hats, everything. So of course, Clayton, who owns Housing Wire, is like, that name might be a little bit too provocative. Let's call you Chart King. I said, dude, no. If you get a marketing name and people are creating merch for you, you go with it. That's how marketing works. So we're going with it. And of course, those who know me, I don't just track housing. I track all economic cycles. So I have any chart you could think of, and I don't really sleep much. My Instagram accounts, I do 10-year yield videos like at 1 o'clock in the morning. And so I'm just a big kind of data geek nerd with good hair. Just that simple, really.
Not good hair, great hair. Yeah. With that being said, when I asked him if he wanted me to share the screen, he says, nope, don't have any charts today. And I'm like, okay. All right.
No charts for you.
No charts for you. I actually looked up Soup Nazi to see what the deal was with him currently the other day. All right. On to other news. I just want to remind people, 34 states allow you to do business purpose loans without a license. Now, I am not for one single second suggesting that some Yahoo who's never done a loan should be doing business purpose loans without licenses. I'm suggesting for the professionals in the group that if you have not explored this part of your business, you should. So DSCR loans, et cetera, make sure that you are paying attention to what is being done out there and what a lot of the businesses, I mean, the bulk of my business in the last year and a half has been DSCR, private money, cross collateralizations, bridge loans, funky stuff that I would have never even dreamt of before. So I didn't realize it was 34 states. Did you get that?
Yeah, that means there's 16 that require a license.
Thank you. Thank you for the fast math, Kevin. That was
Yeah.
very helpful. Okay. So I just want to take a moment also to talk about the client that Kevin heard about who went to a big bank to get a loan, and he was buying a condo. They don't know what they were buying a condo, and they go through the whole process, and then they get to right before funding, and then they find out that the HOA is on Fannie Mae's naughty list. So, Kevin, how did that go?
So this is from a loan officer friend of mine. I was chatting with her and she was telling me this horror story. Fortunately, she wasn't the lender that the client had gone to the big banks. They've now been turned down by all the big banks because the condo, what it turned out was they only have the FAIR plan in California for fire coverage. They don't have any other coverage. So they don't have liability coverage, all this other stuff that a HOA would normally need. So she was asking me, does anybody do this? And I was like, well, maybe a non-QM lender might. And I reached out to a couple of my top reps, and they're all like, oh no, if there's a big claim, you can't get that covered. And therefore all the homeowners would be responsible for that claim. And therefore that pose a big hazard for all the borrowers. And so the non-QM lenders are like, yeah, no, we don't want to touch that. But it turned out that my friend reached out to her company. She's one that works for the big 10 companies, and found out that Fannie Mae will do the loan on the condition that the condo association show that they've been turned down by 3 insurance companies and could only get the California FAIR plan for coverage. And so they can do it as an exception. Isn't that fascinating?
Hey, you know what? I've been thinking about this, and not to confuse things, but the FAIR plan is a $3 million limit on
Yeah.
they cannot be covering HOAs, but they could cover the walls in maybe. Anyway, okay, so we got to hurry up because we have so much to cover. But the point of that whole thing was not the whole FAIR plan thing, none of that. It was that they went to a lender who did not give the seller or the buyer or the seller probably a heads up on what a landmine, a condo association would be.
Yeah.
All the way to the end where they had released their loan contingencies and every contingency, and then find out that they have a property that is not lendable by Fannie.
Yeah, they've lost their earnest money deposit.
Freddie guidelines. So with that being said, educate your realtors, help them educate their sellers. We beat that drum constantly here and make sure that you are paying attention because it really, really matters. Okay, so moving right along. So Logan, I read that the B of A Global Fund Manager Survey revealed that almost a half of the surveyed participants thought that we would have a global recession, and most think that we'll have a mild US recession. And with that, most of them are planning to cut their holdings in US stocks. So what impact does that have on us in the mortgage industry, our clients, all of it? Where's the stock market going to go if the global fund managers are pulling back? Like, how does this all fit together in the scheme of things?
When you look at the history of economic cycles post-World War II, there's certain data lines that tend to break right before a recession. I always like to highlight residential construction workers tend to lose their jobs first before a recession happens. As the Fed gets very aggressive, they stay too tight too long, and then the housing sector in terms of the new home sales gets hit. Going into this year, when we start to see government people get fired, 1/3 of the growth in jobs last year were coming from government. So naturally, if the labor market stays constant or grows, the unemployment rates were going to rise. So the economy was getting softer, but it wasn't breaking. Now you're adding what I call Godzilla tariffs. And when we go back to 2018 and 19, President Trump did not go into the trade war tap dance right away. In 2016, he waited until he got his corporate tax cuts in, then he went into it. I believe they all understand the market stress it can create. And even back then, we had a near 20% bear market, I think, in the Christmas Eve in 2018. However, the economy wasn't breaking, and then they made some deals. And then toward the end of 2019, the economic data started to get better, retail sales, industrial production, housing data, rates fell. So we actually had good data the first 2 months before COVID hit in 2020. Here, I think what's occurring is nobody expected Godzilla tariffs, and you're starting. If you look at the Michigan Consumer Index, it's terrible. I mean, it's like you have spikes on inflation expectations, and then everyone thinks they're going to lose their job. Those are soft surveys which don't fall into the hard data line. So retail sales, housing permits, jobless claims, those things matter a little bit more to the economic cycle. But if you're going to get hit on the corporate earnings sides by, the cost of doing business goes up, something is going to have to offset that, or you get margin compression, and then that could, take the S&P earnings. But we have to remember that we are kind of somewhat priced to a very perfected marketplace going into 2025. So just like in 2017 going to 2018, you were in a setup for market to have some volatility. So it really depends on the next few weeks or months. Are we going to get some deals and some clarity, or is this going to be a back and forth? Nobody technically wins in a trade war. That's why nobody wants one. But the longer this goes, I'm pretty sure more and more people are going to be raising their expectations of a recession. I know the New York Fed president talked about, he's raised his unemployment target to 4.5 to 5%, growth down to 1%. But as long as the U.S. consumer is still consuming goods and services, you can keep the economy going. The business investment is really the question, because in 2018, 19, that business investment fell even with the corporate tax cut. So this environment is less conducive for that kind of an investment with everything that's going on.
So I think it's interesting. The Philly Fed just released their Q4 2024. I know it's old survey. Consumers are stressed. They were stressed then. Only 11.1% of them are making the minimum payments on their credit cards. That's it. It's the highest in 12 years. I mean, the worst in 12 years. Accounts that are 90 days or more are just increasingly rising. They're highs. 1 in 4, and this was not part of Philly Fed, this is another survey. 1 in 4 consumers are feeling stressed, and 10% are feeling completely overwhelmed. So when consumer spending is 70% of GDP, I mean, it's got to have an impact, right? And especially if unemployment goes up, et cetera. So it's gonna matter, isn't it?
Eventually, if corporate profits fall enough, you start laying off people. And then when you have somewhat elevated, see, when we look at the credit stress data, it's a lot of renters, a lot of single household renters. And with auto loans and credit card balances rising is pretty normal with every economic cycle. The utilization rates of credit data is actually pretty low. So where I think people get it wrong is that the majority of household consumption are homeowners, and homeowners on paper have never looked better. Their cash flows, DTI incomes, payments as a percentage of disposable incomes are still low. But the renter class is where you get stressed, because naturally rents go up. The system of the United States of America is really kind of rigged for housing, because you get a 30-year fixed payment, you get a fixed debt cost, your wages rise, you get household formation. So the people that are driving the U.S. are still doing fine, and that's why even today I saw the weekly retail sales data on a week-to-week basis, and it was still showing 6% growth. So consumption is there. I just think there's the bifurcation of renter households and single renter households. Whenever you get credit stress building up in an expansion, it just gets worse during a recession. And I think that's, Fed President Waller was kind of hinting at that if he thinks a recession has happened, he's not worried about tariff inflations, and he'd rather cut rates more aggressively toward the end of the year in that regard. And if rates fall for the U.S. housing market, it's a very unique position. I like to think of this period like the 1980s. The late 70s, home sales were booming. Home prices were booming. We went from 2 million to 4 million home sales, from 4 million down to 2 when mortgage rates got to 18%. We had a lot more inventory back then. We had 2 recessions. Affordability was worse. But when mortgage rates started to fall down, home sales actually went vertical. And back then, a lot of people were saying credit card debt was bad. Homeowners were renters. Nobody's going to buy homes. And as soon as rates fell 2.5%, it actually fell 5% from 18 to 13%. Home sales went vertically higher. Same kind of backdrop here. The irony is that the existing home sales market, we track data weekly, which is about 2 months ahead of the NAR. Our weekly contracts are up year over year. Our total pending contracts are up year over year. Purchase application data has had its best start in many years already. Positive year to date, positive year over year growth. This is before rates made that little spike up higher. So the existing home sales market outperforms in this because it's working from literally from the lowest home sales ever. Like you adjust it to the workforce and households. It's such a low bar. It's very similar to the 1980s. You look at the history of economics, we've had many recessions, but when rates tend to fall and demand is low, it's a very low bar to rise sales in. We had an economy outperforming for many, many years, but the existing home sales market went in recession in June 16th, 2022, and we've been at record lows even with an expansion. So it's the one sector that's set up to outperform when rates fall.
Oh my God, hang on. I just need a moment.
That's good news.
Does anyone else just feel like, never mind, I won't say it. I'm going to keep behaving. That is great news, Logan.
That's great. I mean, the other thing too is I've always been preaching is investment property or property in general is like your best hedge against inflation.
I mean, historically, the greatest hedge really against inflation on planet Earth is the 30-year fixed mortgage. I know my counterparts in other countries hate us because they are, like they're doing 90-year loan modifications in Canada because they're tied to short-term debt. So in that context, the 30-year fix, you get a fixed debt cost, your wages rise every year. In an inflationary period, your wages rise to go with inflation. So not a lot of people know this, but back in the late 70s, when inflation was rampant, home sales were booming. Home prices actually grew faster from 77 to 79 than 2020 to 2022. Like you look at the history of you look at the history of home prices post World War II. Home prices tend to run with inflation. So from 43 to 47 was the hottest home price growth year, inflation back then. The late 70s, home prices were hot, inflation back then. Pandemic inflation, prices were hot. The only time where we lost that deviation is during the housing bubble years. Inflation never took off, CPI, PCE inflation. However, home prices did. That was a credit boom and a credit bust. And you never had the wages to support that kind of price growth. So the whole credit market, once it broke, it was actually breaking years, like 2005, 6, 7, 8, 4 years before the recession actually started in 2008, you started to see credit stress. So it's obviously not that marketplace. So when you're working from very low levels, if mortgage rates head, hypothetical theory here, let's just say they head down to 6%, the US housing market would be the outperforming sector of the year. Everyone's sales forecast would be lower. We get to see things a little bit ahead of everyone else. And even I was surprised. I could see growth happening better if rates headed down to 6%. I never would have thought mortgage rates would be above 6.64%, and all of our forward-looking indicators are all positive. We'll see what happens. This last week, obviously, whenever rates have a sharp increase, we see the forward-looking data get weaker, but it doesn't take much to move the needle, right? And every year that goes by, wages grows, household formation grows, dual household income grows. We have near 5 million total home sales. You take existing and new in 2023 and 2024. So the peak in the last decade from 2010 to 2019 was near 6 million. So we're roughly missing 1 million mortgage buyers to go back to some kind of trend. It's hard for me to forecast anything below 6% because of Fed policy, but it is encouraging to see that the 3 times the mortgage rates headed down towards 6%, demand grew. It's the duration of how low rates could stay there to get some consistent growth rather than we get a few months where sales rise and rates go up, we get a few months of sales fall, and we're just basically hovering around 4 million existing home sales. The new home sales sector is at 2019 levels. They live in a sub 6% marketplace. So that's why their sales are so elevated compared to the existing home sales.
So you are in line with Dr. Lawrence Yun, who we'll have on our show next month, who is forecasting that home sales are really going to go up exponentially in the next year and a half, 2 years, 3 years, to the point where, I mean, he's talking about numbers that when I read them, I couldn't believe it. So it sounds like he's onto something, holy moly. And that's, I mean, wow. This is not the tone we have been getting recently from anyone. And it is interesting to see how fast things can turn because, again, go back to last Friday where it looked like the sky was falling, it was going to, stay there. And then by today, the yield is back down to something that's palatable. And so anyway, okay. So you said something, you talked about affordability a couple of times. I want to touch on that because this is being shouted from the rooftops. It's on every social media platform. It's on all the major news channels. All that you hear about is how unaffordable things are. I mean, housing is, you can't buy a house,
Mhm.
blah, blah, blah. And I keep saying, I believe that what has changed is we didn't used to all drive fancy new cars. We weren't eating Uber Eats 4 nights a week. We weren't at restaurants all the time. We weren't going on, like our lifestyles have changed as we're trying to keep up with the Joneses or whomever might be living next door. And so is it really unaffordable or are we just prioritizing things differently? And now you're saying that it's more affordable now than it was back. Talk us through this,
Well,
please.
the 1980s was the worst affordability, but we got to remember that there was 18% mortgage rates back then.
Yep.
So that's the only, if you take affordability total, the total PITI payment in retrospect to affordability models. A lot of people like to use median income to median prices, but that takes the rate variable out of the equation. So when you look at the hypothetical theory of economics, you have near 5 million total home sales. You're missing 1 million. So the constant breach is, who are these 5 million people? Well, millennials tend to be the highest home buyers in America. They lose their title to the baby boomers when rates go up because they finance 90% of their home purchases. So if you get, I mean, I think this was the shocking thing for a lot of people. Nobody thought purchase application data would be positive year over year or with affordability here, but we're working from, like I always joke around, the last time purchase application data was this low, Gangster's Paradise was like the #1 song. No Doubt was the new band. It was the mid 1990s. We have a lot more households in formation here. So always think of housing home buyers as kind of like that middle to upper middle class. So people say, well, how does this work? Well, the math isn't that crazy. If you need between 103 to 116,000, take the NAR data, to buy a house in America, dual household incomes were more than 60% of the purchases. Somebody makes 90, somebody makes 70. There's your, home buyer right there. So you have near 5 million total home sales with affordability that's bad. So it doesn't take much to get you back to some kind of normal curve. But the new home sales market is still back at it's just back at 2019 levels. That would equate to another million existing home sales, but they live in a sub 6% mortgage market world. So if that was the case, home sales are growing, everybody would be wrong about home sales, but I just can't get there with Fed policy right now. But the builders have shown you could keep sales elevated with lower mortgage rates. Of course, they're buying down mortgage rates to get at their corporate profit margins are much better now than the 2008 crisis. So they can do it. It's hard for me to get down to that level to where I can really see sales grow in a meaningful way with duration with Fed policy where it is right now. You need the labor market to break or the economy get weaker, or the Fed eventually cuts 1%, and then you just have a lower bound where the 10-year yield can go with.
So what are you seeing with the tariffs and home building is? Because I was getting a job quote for something and the contractor was like, well, we're going to have to possibly raise our costs in the next few weeks because of tariffs. And I realized they were just kind of pressuring me to move quicker on the decision as to whether to move ahead on the deal or not. But it's like, well, how much more is lumber going to cost? How much more is this going to cost? And how is that going to affect building? And will it slow home building in the country?
So I remember going on CNBC a few weeks ago. I said the best cure for tariffs is lower mortgage rates. This is why the Trump administration and Bassett and everybody wants. And the theory behind that is that lumber prices were $1,000 higher during COVID.
Yep.
And their builders were fine selling homes. They import about 7% of their total housing costs. overseas. So naturally, their issue is that their total active inventory has been growing, their total units completed. Usually when it gets about to 120,000, going back to the early 60s, the builders tend to really pull back. Their profit margins are getting hit. It gets more and more expensive when rates go higher to buy down rates. So the South is really their problem because it's much more unaffordable there because of insurance and taxes, Texas, Florida. They're at the point where housing permits have really gone nowhere for years. But other areas, they're still able to sell homes. New home sales is not very elevated right now, so it's not like you're working from a very high level. Rates get down to 6%, they can sell more homes. But in terms of cost, they have corporate profit margin pressures. Now you add, tariffs onto it. It just puts more pressure on them. That's why the builders were the first, sector to write to President Trump to try to get exemptions out there, because any additional tariffs, they're going to raise costs, but they don't have the luxury of 3 or 4 or 5% mortgage rates. So they're just going to eat it, a lot of it. So it's going to be more difficult for them to kind of pass that on in this environment. If mortgage rates were at 5, 6%, then it's much easier for them to do. So I look at the builders. I was the wild card for 2025 as their supply was rising. The South is very weak for them. If mortgage rates stayed elevated, you could start to see residential construction workers lose their job. And if you look at that with every cycle, that tends to be the leading indicator. It's one of the reasons we never had a recession already. That data line has never broken in the last few years.
Good Lord. All right. So let's talk about delinquencies. So delinquencies are still extremely low. They have gone up.
You're talking mortgage delinquencies?
Mortgage delinquencies. Thank you. 31,000 higher year over year, but 90% of that rise came from FHA. So let's talk through that, because again, we still have people out there saying the sky is falling. Oh my God, there's going to be a bubble. And, there's going to be all these foreclosures, which we haven't seen any indication on that. But talk to me about the delinquencies and your thoughts on that.
The thing about housing is the prostitution of housing after 2008 has been basically a bunch of untrained housing doomer people going on YouTube, TikTok, and all this stuff. And they don't actually have functioning models or anything. So my job, a lot of people know me for, is like just absolutely lighting up the housing bubble boys for the last 13 years. So what I've done category wise is every single year, they have a reason for home prices to crash. If you look at the history of home prices going back to 1942, it's actually very rare for nominal home prices to ever fall. If I took 2007 and 11 out of the equation, 1990, you were down 0.7%, and 91 at 0.2. We've had many, many recessions post-World War II. We've had double-digit unemployment rates, credit stress data. The foreclosure crisis, people like in America are just like the worst of the worst. Like, I've dealt with the Russians and Chinese and Iranian trolls for like 10 years, but a foreclosure crisis needs like a massive, like we had like 5 years of credit or 4 years of credit deteriorating before the job loss recession in 2008. And then you had the 12 to 15 million delinquencies. 1 to 4% delinquencies are norm. That's just the normal of every cycle. It's like 1.5 to 2 million people lose their job each month. People don't know this, but that's just very normal. To have a foreclosure crisis, you need a lot of late cycle lending with the loan to value data looking bad. So here's an example for everyone. How I do my presentations, I go around the country and do this. We call it the NER Tour. In 2008, the loan to value data was 85%. In 2010, over 23% of the homes in America were underwater. Our new listings data, these are to be fair, none of these people are actual analysts. Our new listings data, the homes that come onto the market, and this is the big variable key. In a normal year, you get about 80 to 110,000 new listings per the seasonal peak months. During the housing bubble years, it was running at 250 to 400,000 per week for 4 years, because these are forced credit sales. The sheer size of delinquencies in relationship to the market were massive back then. And it was starting in 5, 6, 7, and 8, and then the foreclosure wave. Now the loan to value is like 47%. The minimum down payments for the last 2 years is 15 to 18%. 40% of homes don't have a mortgage. The FICO score DTI profiles in America are the best ever. You cannot get a group of fanatical, crazy lunatics than these people who are talking about big, massive foreclosure crisis where the home prices are going to go back down. And again, I always say, unless these people actually show you their forecasts and models, you have to be careful about this because they're simply not trained or educated or talented enough to actually create a model where prices could escalate down, which is very historically rare, right? You could get real home prices to fall, but nominal home prices in that. And we've had recessions before. So late cycle lending, especially with FHA, is a legitimate concern, but FHA is 15%. This is why you don't see these big percentages, but you want to kind of go with that discussion rather than every week foreclosure crisis. They're not reporting this, they're not reporting that. You have to take the whole equilibrium of housing economics and how it works. I mean, the whole foreclosure process minimum is like a 9 to 18-month process, right? But we always say that we'll see the data first. Like, for example, Mike Simonson, my colleague who owns Altos Research, he was the one that went to Lehman Brothers in 2007 and said, hey guys, we have a way of tracking housing data much more prolific than anyone. We believe the housing market is breaking because of all this. Lehman Brothers looks at him and said, get away. We have 85 analysts. You don't know what you're talking about. Mike goes down 20 feet, talks to Goldman Sachs. Goldman Sachs takes the information, shorts the housing market, makes $10 billion. Lehman goes out of business. We are not shy. We believe we are the most prolific housing data trackers on planet Earth, and we are willing to challenge any American, Russian, Chinese, Iranian citizen any day, live 24/7. And the credit things are just being overblown because of the scale of the discussion, right? If the LTVs were at 85, that's one thing. If the constant cash out refinances were done on exotic loan debt structures, that's one thing. None of that's happening or has been happening for 14 years. And it's a long drawn out process, but we never really had a sales credit boom in America. I encourage everyone, if you want to look at something that really puts this in a glaring note, look at mortgage purchase application data going back to 1991. There was a massive boom in 2003 to 2005. Adjusting to inflation, housing credit was crazy high. None of that's happening for years, and the down payment levels are the highest in the 21st century. So two different marketplaces. I always tell people, stop dancing with a ghost. Like, there are men in this country who've never literally mentally recovered from 2008. They think every single thing is a home price crash, and they're all wrong. That's why you get their forecasts, you get their models, and you absolutely thrash them in front of everybody. So the next time they open their mouths up, they could go, oh, maybe I don't know what I'm talking about, but I just want attention.
Well, we've been following you, and we've been talking about this, and the tenants, the renters right now, the people, we used to think that people rented until they could buy. And now what we're seeing is people are renting because they don't want to maintain a house, and they make tons of income. And it's like, they are so missing out on this opportunity to buy into real estate now.
So for the record, I just want to make sure that we preface this by saying Kevin knows this in real time because he has a house that he's renting in San Francisco right now. And the tenants who are applying, their incomes are off the charts. Their credit is perfect. I mean, the reasons for them to rent and pay this amount of rent is insane. And so it is a very different narrative than we've had in the past.
In that context, I'll tell you a funny story. When somebody ever asks me, should I buy a house? This is my answer always. I tell them, hell no. If you are asking me if you should buy a house, you're a grown adult. You are your own household. Why are you asking a stranger if you should buy a home? Millions and millions of people buy homes. You're not ready, man. You might never be ready. You might be able to rent for the rest of your life, because if you have to plunge your toilet, you could get your landlord to do it for you. But grown-ups, millions of people buy homes every year because they're ready. With qualified mortgage, you get yourself to a loan officer, you find out what it is. If you don't like the payment, no, don't do it. Rent, there's nothing wrong with you renting for it, but whatever you do, you do not ask another adult if you should buy a house. There's a 27-year-old lady right now in Ohio. She's buying a house. She's ready, right? Single women have outbought single men for a long time. But if you're a guy or like it's asking, should I buy a house? It's the cost of shelter, right? It is a fixed debt cost of shelter. There's property taxes, insurance, like all grown-ups have done post World War II, right? So it's a very simple model we use. Americans, we're not complicated. We rent, we date, we mate, we get married, 3.5 years of marriage, we have kids, we buy single family homes because you don't live in apartments. That's what grown-ups do.
Wait,
And
you
if
gotta say
you
that
don't
again.
feel,
Wait. We rent.
we
We
rent, we date, we mate, we get married, 3.5 years after marriage, we have kids. Typically, that's when you start to buy single family homes and move from apartments or townhomes or something to that nature. That people are just getting married a little bit later in life, so the curve is a little bit different. But you don't want to make this complicated. Housing is the cost of shelter. Like if you are not comfortable sleeping with that payment and waking up with it every morning, don't do it, because millions of other people will. It's not anyone's job to convince anybody to buy a house, right? It's something millions of people do. Your job as a professional, everything, get people pre-qualified, let the real estate agents find it and go with that. But man, if people are asking me, I just think you are not financially or emotionally ready to buy. There's nothing wrong with you renting for the rest of your life. But these people buy, and that's just how the world has worked for decades and decades.
Mhm.
Okay, I am gonna say that there is a slight difference between them asking you and them asking me and Kevin, because when they're asking Kevin and I, they're saying, can you go through my financials and tell me, like, on paper, does it make sense? And I've had to do this many times with people who are like, because they hear the news, Logan, they are seeing the headlines telling them how unaffordable it is and how the average homeowner has to pay an extra $18,000 a year for blah, blah, blah. It's all, so they're getting pumped full of all this crap. So there does have to be some sort of counter narrative that is presented as an option.
That's my counter narrative, because we're still going to have near 5 million total home sales again. I just think there's some people emotionally that they shouldn't buy homes. It's like I joke that there's some people that should never trade stocks because they become such marshmallows whenever things get
Yeah.
hectic. And I just think I always tell people, don't waste time on people who are just too afraid.
Yeah.
Put all your energy on people that are serious. You get their financials, you give them the total payment. If they qualify, they qualify. If they don't qualify, they don't. But focus your energy on the millions and millions of people that do buy. Because here's the thing. A lot of people said in November and December, well, nobody's going to buy homes because nobody's sure what policies are going to happen or everything. Literally, purchase application data was having its best year in years.
Yeah.
It's a very low bar, but even with all the crazy headlines, because it's a shelter cost, right? One of the things I always tell people, one group of people we never listen to are middle-aged men podcast stock traders. They're like the worst of the worst. They've been telling people, oh my God, everyone's going to run to sell to keep their money. I was like, where are they going? Majority of all sellers are buyers. Go tell your wife you're going to sell your house. Your kids are going to have to go to another school because you're afraid of losing your equity in your house. Homeowners don't do this.
Yeah.
Like literally, we have decades and decades. Homeowners do not act like middle-aged men podcast stock traders. So in this context, it's a shelter cost. If you sell your house, you need another form of shelter. And since 70 to 80% of people buy, that's the equilibrium housing economics going decades. And the problem is, in the amplified social media world post-2008, the people that generate like the highest viewers are the biggest doomers in the history, and they won't change. And the academic world never takes them on, right? So some of us decided, oh no, we have to play on their grounds. So a lot of people know me. If you go on YouTube, I've debated so many doomers that I just simply say, you show me your name, your face, your 5 years forecast, and let everybody see your models. Zip. Not one man in America has accepted my challenge. And I say, I'll give you 30 minutes before you have to debate me all and run away, because they don't really kind of believe this. It's just in this society, if you lie and scream and become the biggest yellow journalism doom porn person, you get generation clicks. It's engagement farming. Economics done right, it's not supposed to be fun and sexy. It's actually a very boring, tedious work, right? 2,000 years ago, I was that old guy in a dungeon with candles reading scrolls. Now you got TikTok and Instagram and everything, but the academic world has kind of allowed this to stray. Some of us, we're pilgrims in an unholy land. We try to fight this on their battlefield. So I try to make economics as fun and understandable as possible. And we've had success over the last few years with the nerd tour, but all I'm teaching is macroeconomic cycle modeling work. Not the most exciting thing in the world, but we try to make it as fun as possible so everyone, consumers, realtors, loan officers, everybody has a kind of idea of what's really going on so they can talk confidently about the housing market, or the consumers can feel this about the housing market. But if you allow that world out there to mess with your minds, it's like every day where it's the Great Depression, but it isn't. And I've always had this token line: all American bears have failed since 1790. Economic cycles come and go, but there's a long graveyard of people, and things used to be a lot worse in the 17 and 1800s, like much harder than it is now. And now we have certain advantages that other countries don't have. So, yeah, kind of be careful who you listen to out there.
100%. So, Logan, you don't know this. We've been doing this show for more than 5 years, 51 weeks a year. And to say that we've learned a lot is putting it mildly. But one of the things that we have focused on in the last 5 years is the headlines that are not correct. Oh God, sometimes this hour of this week is very hard for me to like. Anyway, so my favorite of all time was the foreclosures up 175%. I'm like, what the? I mean, seriously, from a foreclosure moratorium
Yeah,
under
it's
0 to
funny.
1.
It's funny you should say that. That's my one of my famous videos is speaking at a conference, and I actually show all the foreclosure data going back to 2003 and showed what it looks like. I call it crayon economics. I draw these black lines for even somebody, a kindergarten kid could understand this. And the foreclosure data is so small that I'm doing this on stage. I have to run to the actual chart and point it and go, everyone, you see this? It's too small. It will not get the job done. That, you could see stress building up, but when you're working from the lowest levels ever, these percentages are going to be extreme. I think the podcast guy said foreclosures are up 700%. Home prices are crashing in 2023. And I was like, no, homie, it does not work that way. So the way to attack this is make the data fun to understand and let everyone give them charts and things to read and make it simple and stuff. And then after a while, people start, wait a second, these people have been wrong for a very long time. Why? They're not data analysts. They're not economists. They refuse to forecast. They have no working models. And I'm trying to challenge every single one of them to a live debate, because trust me, there's very few people on planet Earth that could go head to head with us. And it sure ain't them.
Right. You can't get anyone to dance with you, can you, Logan? All right. So we had in the last week both CPI and PPI, producer price index and consumer price index for the month of March. Normally, we would have a little chat about this, but today I'm going to summarize. Those were all pre-tariffs. They're kind of moot at this point. So there's a fair amount, like 12% of the data that feeds into PCE, which we're going to get on April 30th, which is the Fed's favorite measure of inflation. So we will see what happens. But in general, those reports were better. Yay! Gasoline's down quite a bit. Even I'm noticing it at my gas station, which is always the last one to catch the memo that gas prices are supposed to be going down. So with all that being said, we seem to be going in the right direction. Logan, anything to add?
Obviously, when we think of CPI and PCE inflation and PPI inflation, 44.2% of CPI is shelter. And a big portion of that is rent. So single family rent, the growth rate is slowing down as more supply is coming to the market. So it's really hard to have breakaway inflation unless rents take off, right? Or you have an oil shock, right? Adjusting to inflation, oil prices have to be like $450 today to get that kind of level. Then there's the PCE, where the shelter inflation is only about 16 to 17%. So if people want to know why is there like a gap between CPI and PCE, it's that. I think the PCE month-to-month data is going to come at 0.32%. But again, the Federal Reserve and everyone's already raised their inflation targets because of the size of the tariffs. So you're probably going to see PCE inflation go back up to 3.5 to 4.5% if that occurs. If the economy weakens, goes into a recession, it's harder to keep those prices elevated. The stagflation model that people talk about, the late 70s was very high inflation, but like housing was booming back then, oil prices, it's very hard to get that But if you wanted to create a minor stagflation, you could think about nominal GDP running at 2.5%, but PCE inflation running at 3 to 4, and then the unemployment rate gets up to like 5.2. Stagflation would have to be like a very, very smaller version of what we saw in the 70s. The Federal Reserve is kind of like already hinting that they don't think if there's a recession, they don't think prices can stay elevated as consumption starts to come down and confidence starts to come down.
Yeah, it'll be interesting to see what Uncle Jerome has to say tomorrow afternoon. Yeah. All right. So I just want to mention briefly, because I don't know, have you had a client who was pissed off that 5 million people called him after you ran their credit report because you forgot to tell them to opt out?
No, that has not happened to me because I coach all my clients how to opt out.
No. Kevin does this very
Oh, but we should have NBA's got a. You're about to go this, weren't you?
up. Okay. So I was going to start with not NBA because, these two, I swear to God, have a hard time playing in the sandbox together. So NAM is saying that they dropped a trigger lead bill and that they're united with NBA. If you read NBA's account of this, they do not mention NAM. I don't know why. Like, why can't we all get along, for God's sake? Bottom line is, a bill was dropped in Congress again. It's Senate Bill 1467, House Bill 2808, and it has bipartisan support. That's a blessed relief, finally. And finally, we don't have NAM and NBA dropping separate bills and then trying to combine them and. If you will recall, the Senate passed the bill last year unanimously. And then at the last minute, a retiring congressperson who shall go nameless, but if I could remember his name, Henry, that's what it was. Yeah. He, on the last day, they killed it in the House, which was so frustrating because it is so freaking egregious.
So close.
What?
It was so close.
So close. It was the closest we've ever been. And this is it's a far cry from years ago when we would walk in to the congressional offices in Washington, D.C., and we would look at the Congress people and talk to them about trigger leads, and they would think that we were just trying to get it so that we didn't have any competition. I've literally been told that by Congress people many moons ago. So we have gone from that to finally, it looks like there's a lot of support for this bill. So I would suggest that you go on nam.org and go to their advocacy dropdown. Never mind that I have begged them to put it as the front and center thing on their website, so it was easy to find, but no. Regardless, go to their website and do their call to action so you can contact your Congress people. They have a letter there for you. I think we'll have someone on here to talk about this further at some point. Bottom line is, this is something that will be good for all of our borrowers, because the stories that we hear, including people going to the emergency room with anxiety attacks, the CFPB has said that they've seen up to, more than 100 trigger leads for one credit inquiry. It's just insanity. So
I've seen more than 100.
That's good news, right? Kevin, you cannot count that high. So don't give me that.
Yeah, I'm just telling you what my clients tell me.
Well, they can't count either. Anyway, okay. So with all that being said, Logan, I have heard that Canadian lumber and smartphones are going to be exempt from the tariffs. Have you heard this too?
Yeah, there's a lot of rumors on what will or what won't get exempted. Just always remember that a lot of this is negotiating tactics for a final ending. One of the reasons why it's hard to do like a synthesized trade war for a long period of time is the U.S. has 2-year political cycles. And because Congress can control tariffs, if red states start to lose jobs and all this noise with the economy gets worse and worse, Republicans don't have enough House people to withstand a lot of losses. And the Senate is already kind of not on board with tariffs if they get worse and worse. So to me, I've never actually believed in the concept of a authentic long-term trade war. Because if you really believed in a trade war, you wanted to change it, you simply put the tariffs in on day one. No negotiation. But we're always trying to negotiate something. When you start to do that, you're not fully committed. But it's also very difficult in a 2-year cycle because politicians try to regain their power back from the car, and then it goes into another discussion. So whatever the president has planned to do, he's got a very small window while the labor market is still working to get things done. It becomes more and more difficult when the labor market starts to break especially in red states. There's already a farmer bailout that's being talked about this morning. So again, nobody kind of wins in a trade war. The U.S. has a very, very unique advantage over a lot of these countries because we're the biggest net powerful consumer. But we'll see what the final thing is. But I always say it's kind of tariff on, tariff off, and eventually, if you bluff too much early on, you have to do something. They did this, and we'll just got to move on with the process. What the final game is at the end.
Well, so thinking that maybe it's a negotiating tool is counter intuitive when you hear Commerce Secretary Howard Lutnick and President Trump both indicate that they want to have the tariffs replace income taxes for folks who are making less than 150 grand a year. And they also want to pay down the debt and they want to abolish the IRS. So in a very short amount of time without being political, can you please comment on that?
There's no mathematical way to pay down the debt. It's just not real. I think if you ran a tariff model to try to like capture enough revenue, you'd have to tariff everything like at 73%. Every politician lies. We actually just started our debt cycle because age is 65. Our elderly dependency ratios are very high now because of our aging population. So the mandatory payments are more now than any other time in history, and the net interest expenses are rising too. So we don't even have enough people working or at a higher tax rate to actually do this. So paying down the debt is mathematically literally impossible. I never think or worry about it because I always tell people I'm never worried about the U.S. loot, like dollar collapse and everything. Like the notion that Canada is going to buy New York, their currency is going to be great, or Mexico is going to buy California. Like all these weaker economies are going to have their currencies, and the U.S. don't know. I mean, we have $190 trillion of financial assets, but if you put the U.S. together in total with land and everything, $300 and $400 trillion. So the kind of dollar doomsday people or other countries are going to break first before we do. But paying down the debt is just not feasible in our structure right now. Nobody's going to raise taxes high enough, and nobody's going to cut entitlements to have this kind of sporadic 20, 30-year process of trying to pay down debt.
Hey, Kevin, did you hear him? He just called 65 elderly.
Yeah, I know. Really elderly.
Okay, so we're going to leave abolishing the IRS and replacing income taxes for another day because I want you to lastly tell us how the tariff impact is impacting hedge costs and how that impacts pricing and the rates.
Unfortunately, what happened after the tariffs went out is the markets got stressed. If anybody remembers the Silicon Valley banking crisis, the spreads were getting better up until the Silicon Valley banking crisis. And we got to the worst levels of the spreads in the cycle, about, I think, 3.10%. Whenever we create market stress like this in a very short of time, the spreads get worse. And it costs everyone in the mortgage industry in that. We were heading to a very, very good area. Spreads were getting lower, and whenever yields went up, the mortgage-backed spreads would actually get better, so it limited the damage. And then chaos happens, very similar to the summer of 1986 when the spreads got really bad. Now, history showed us that spreads do get worse during a recession, but we've had recessions that the spreads actually get better. But in this case, this is pretty much market stress. If we get back to normal, the spreads were heading down lower and lower. They weren't going to get back to 2% this year, but they were in a much better spot. Just to give everyone an example, if we took the worst levels of the spreads in 2023, mortgage rates would be near 8%. If we took the bets or the normal spreads, mortgage rates would be near 6%. So we're still working off of that 75 to 1 basis points difference right now. But whenever you have a market stress and bond markets are acting crazy and hedges aren't working and funds are going out of, mortgage spreads tend to go up, and that's what has happened recently.
Interesting.
All right. Well, I just have to say thank you. This has been the cheeriest economic report that we've had, and I'm not even sure.
That was fascinating, actually, that last comment.
I would also like to say that it happens every time you think you're headed towards, oh, things are getting better. Then you got Silicon Valley or a debt ceiling crisis, or Ukraine gets invaded by Russia, or there's always some crazy crap coming. So we have learned in our 5 years of doing this to not really get too entrenched in the idea that, this is going to happen, the rates are going to get better. We are all about you focus on what is in front of you, which is people who need a place to live, want investment properties, all of the zillions of products. That's a technical mortgage number, just in case you've never heard it, Logan. And go get a loan and go help somebody own a house or an investment property or something. With that,
How do people find Logan if they want to find Logan?
oh my God, are you kidding? You just go to Instagram and you go
Chart Daddy?
Chart Daddy. That's it. So, Logan, I cannot thank you enough. We are very grateful you are here. We will look forward to having you back. And with everyone else, just have a wonderful week. Go get some loans. They're out there. Bye, guys.